You say 4.5% is where the 10-year yield will be going. What's that path like for the stock market, that march to 4.5%, since the march from 3 to 3.25 has been pretty rough?
Yeah, I mean, we're sensing it right now. I think that we have to keep in mind that interest rates, thanks to financial repression and central banks, have been artificially low for nearly the last 10 years. And so when you consider that tug of war that typically occurs between stocks and bonds, stocks have been the only child in that asset class, and they've been getting a lot of assets. As interest rates move back to fair value, which I argue is 4.5, that's just simply nominal GDP, that's going to start garnering more assets in that direction. Already, we're seeing the 3-year nearly at 3%. So, as the fixed income market becomes more compelling in terms of yield, that's going to put pressure on especially these growth, long-dated kind of stocks that have a long duration.
Mariann, a day like today is pretty tough. We are close to session lows right now, with the Dow down by 514 points right now. What is the market telling us? Is there a question about growth here in the United States? Is there a question about rising rates? Will rates quash this rally? What's the market dealing with today, you think?
Well, I think it's a function of PPG talking about pressures on their business, whether it be overseas because of the strength of the U.S. dollar, or tariffs driving up their cost of materials. But, just a deceleration on the sales side and a deceleration on the earnings side. Now, will this carry over to most of the companies that are going to be reporting in a couple of weeks? I don't know. We'll have to find out when it does. Tariffs are still a big question mark with China. We can't extrapolate that at this point. What I do know is that the rate of inflation is still under control. I know that the wages are finally coming back after so many years of no wage growth. So that's very much under control. I see that unemployment is low and at a very good point. So there's a lot of factors, manufacturing, services indices, they're all very strong at this point. So I'm tending to believe that the quarterly reports will be okay. We're talking about 20% earnings growth this quarter, and probably the next quarter as well. I would like to back up and talk about Powell for just a minute. The people who've studied Powell have said that he is very data dependent, much like Janet Yellen was. And so I don't think a fourth interest rate hike in December is guaranteed. I think he may pull back and look at the data as it comes in these coming weeks, and then make a determination. But, to get interest rates back up to that 4.5% rate is actually very positive for financials, and we like some of those.
Jack, so how do you change your portfolio? I mean, if you are a believer that the economy is still pretty strong, that earnings growth should come in pretty decently for the third and fourth quarter, but there's that question mark because we still have not seen the full impact of the most recent round, the bigger round of tariffs yet on corporate America. How do you invest?
Yeah, I mean, first of all, equity investors have been rather skeptical of this 20+ % earnings growth. Keep in mind, through the 2 quarters, we had 26% earnings growth, and the S&P was up 10%. So there was some of that, we'll call it a skeptical discount that's going on, knowing that we're not going to see 20% earnings growth as far as the eye can see. But that said, all other things being equal, and I take all of the economic data into consideration, assuming that's just flat, the fair value of the 10 years, 4.5%, just 2.5% for real GDP, plus 2% for inflation. And of course, that's largely the ECB and the BOJ that have been helping keeping rates artificially low. But now we see the German 10-year move from about 0.3 to 0.6 something in the matter of about 8 weeks, and that's starting to untether the U.S. Treasury 10-year.